The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
With the FDIC now in control, customers can access up to $250,000 on Monday.
A major development in the banking world. The FDIC just reported that California regulators shut down Silicon Valley Bank.
And Friday marks the end of a rough week for the banking industry. The FDIC, which insures deposits and supervises financial institutions, also took control of Silicon Valley Bank and its $300 billion in assets and deposits.
On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action.
Stephen Kulb is the CEO and co-founder of Shelf Engine, a Seattle-based startup that helps grocery stores reduce food waste using AI. In March this year, Kulb was in the middle of a meeting when he received a panicked message from a fellow executive about a bank run at Silicon Valley Bank. Depositors were attempting to withdraw $42 billion from SVB on that day alone, and the bank was on the verge of collapse. For Kulb, this was a huge problem because Shelf Engine was holding millions of dollars at SVB. He quickly opened a bank account at JPMorgan Chase and tried to wire all his company's funds out of SVB, but the transfer was one of many that failed. News of these failed transfers resulted in mass panic, causing one of the largest bank failures in US history. So how did SVB become one of America's largest banks, and how did it go bankrupt so quickly within a matter of days, taking a 40-year legacy down with it? SVB was founded in 1983 to offer banking services to tech startups in Silicon Valley. It was originally headquartered in San Jose, but gradually expanded, opening offices in Massachusetts, Israel, the UK, China, Europe, and Canada. The bank suffered during the dot-com bubble of the 90s, but managed to recover and grow significantly to a point where, as of 31st December 2022, SVB had $209 billion in assets and $175 billion in deposits. It had also been the banker for a staggering 44% of American venture-backed technology and healthcare IPOs. Andrew Metrick is a finance and management professor at Yale, and according to him, SVB had been around for as long as the organized VC community. It was considered to be an establishment bank and was a significant institution in Silicon Valley. Unlike most other banks, SVB specialized in serving startups and tech companies and was also willing to extend small lines of credit and handle payroll for young companies that weren't yet cash flow positive. Because of this, the bank was able to build strong relationships with VCs and so-called quote-unquote economic toddlers that allowed it to grow through positive word of mouth and expand into private banking for wealthy clients. The COVID-19 pandemic was a huge catalyst for the growth of tech startups. Consumers were spending more time online, and because of this, the demand for digital services and devices was at an all-time high. Entrepreneurs and investors jumped on this opportunity, and SVB stepped in to provide banking services, causing a significant amount of growth in the bank's deposits. The bank's management decided to invest this excess cash in long-term US Treasury bonds. This is because these tend to offer higher returns than short-term securities, but what decision makers at the bank didn't know was that this strategy would backfire horribly not too long after. SVB had previously enjoyed a prolonged period of what is known as zero money interest rates. Simply put, a zero interest rate policy is when a central bank sets its target short-term interest rate at or close to 0% with the goal of spurring economic activity by allowing businesses and individuals easier access to cheap credit. Low interest rates served the bank well while they lasted, but when the Fed began to raise rates to combat inflation, SVB ran into trouble as clients began demanding higher returns on their deposits. To meet these demands, the bank was forced to sell some of its bonds at a loss of $1.8 billion. Under ordinary circumstances, a fall in the value of the bonds wouldn't have posed a problem because the bank was under no obligation to recognize the loss as long as it didn't liquidate the bonds. But as consumers lined up trying to withdraw money, the bank was forced to realize these losses and subsequently declare bankruptcy. Investigations into the collapse have also revealed other issues that contributed to SVB's failure. Internal controls hadn't kept up with the bank's growth, and the bank also failed to manage its interest rate risk in spite of warnings from regulators. Bernie Sanders also blamed an absurd 2018 law for the bank's failure. This law eased credit requirements imposed under the Dodd-Frank Act. This act required banks to undergo annual Federal Reserve stress tests and maintain at least $50 billion in assets in the wake of the financial crisis of 2008. Michael Barr, the Fed's top banking regulator, described SVB's failure as a textbook case of mismanagement. SVB remains under investigation as some believe that the bank's management had something to hide. And according to estimates by the Federal Deposit Insurance Corporation, the failure of SVB has cost America nearly $20 billion. If you've enjoyed the video so far, please do like the video and subscribe to our channel. It doesn't cost anything and helps our team out more than you know. Now back to the video. As of now, First Citizens Bank has acquired SVB in a deal announced by the FDIC. Under the acquisition, First Citizens Bank will take over most of SVB's deposits and loans. These amounted to nearly $199 billion in deposits and $167 billion in total assets. The FDIC, on the other hand, will retain control of whatever remains. Depositors will have full access to their deposits, and the FDIC's Deposit Insurance Fund will cover those who are uninsured. The Fed is also creating a bank term funding program to safeguard institutions affected by the market instability caused by SVB's failure, while the Treasury Department will provide up to $25 billion from its Exchange Stabilization Fund as a backstop for any potential losses from the funding program. There will, however, be no bailouts or taxpayer costs associated with any of the new plans, and shareholders and some unsecured creditors will lose all of their investments.